So, do I look like Richard Petty? Hey guys, what's going on, man? I just had my sunglasses sitting here, so I thought I would share them with you. I don't know why, but hope you guys had a good week off. As you can tell, my voice is mostly back. I've got a little bit of congestion still, but I went through a whole round of antibiotics, and it did absolutely nothing. And so I went back to the doctor and they prescribed a different antibiotic, and lo and behold, it seems to be working this time. So I'm super excited about that. I'm really excited to be back with you guys tonight. So looking forward to spending some time looking at alphabet soup. I don't know if you guys ever did this as a kid, but when my mom would serve alphabet soup, we would try to make words out of it, but never did I spell out the word Google. And so anyway, years later, that's what alphabet soup really is. So yeah, thanks, Pat. He says I sound normal. So that's good. So let's see, where do we get started? Let's see who all's on. And I'm going to share tonight my thoughts on Google, Alphabet. And so, it's worth what you pay for it, right? So let's see who all is on. Got my friend Steve C. He says, Russ forgot the news this week, so we are depending on you. Yeah, I appreciate you too, man. So yeah, we will definitely hit that. We'll do it maybe about halfway through. So yeah, absolutely, we'll hit that. What's that called? My Simply Safe dividend news. So we'll definitely hit that. Let's see. Rust is on third largest holding. Wow, that is really good. So yeah, I'm curious to see my thoughts as well. So we'll see what they are. Yeah, hit the like button. Thanks, Michael. It's good to see you on here. It is good to see that those likes go up. Let's see. Shannon's on. Shannon does not have any Google. He says it's too risky for him. I certainly get that. That is, it is not for the faint of heart. Let's just put it that way. Pat, my buddy Pat is on. It's good to see you, man. Fenders 53, Mr. Incomes. Good to have you on tonight, man. So yeah, good evening to you as well. Let's see what else. El Dynamico, Mr. Antonio. It's good to have you, buddy. It's time for some Chef Boyardee alphabet soup. Absolutely. So, yeah, thanks, Fast Eddie. I'm glad I'm feeling better as well. And, it was really frustrating for me not to be able to talk because, there's things that I want to say and there's, so it takes my voice to do that. And I've never wanted to learn sign language more in all my life than this past couple of weeks because I could not talk for very long. Otherwise, I would just squeak and it would just be awful. So anyway, I did not learn. I know a little bit of sign language, but only what Miss Rachel off of YouTube teaches my granddaughter. So that's as far as I got. Hey, Jim Betts is here. Good to see you, man. Google's your second largest position. Fantastic. So hopefully this will be good for everybody. So I'm looking forward to that. We got Suzuki Man on board. And Steve says, hola todos. That would be hello, everyone. So Russ wants to know how's the honey business going. I'll give you, an update on that a little bit later. Yeah, Jim says, I got to earn a like button. There you go, buddy. And hopefully I will. Let's see. Rust. All right. I think we've kind of hit the scene now. So let's go ahead and get this thing kicked off. I'm going to flip over to the presentation here. And to do that, I will do this right here. Sorry, Jim, got to take you off the screen. Yeah, I think that works. So episode 47, believe it or not, 50's coming up. And so in about 3 weeks, I got to follow up with my buddies Russ and Ryan and see what we want to talk about that night. So anyway, tonight is alphabet soup, my take on Google. So let's kind of. So how did this come up? I have something on my Discord that is called "Questions for Kevin," and a question for Kevin came in, and it's KWESTION. But a question from Kevin came in from my buddy Ex Dividend Dad, and Ex Dividend Dad says this. He said, "Can you cover your thoughts on Google? What will happen from here, timeline, and what will happen if Google gets rid of Chrome into a second business?" So that's a fantastic question. So I thought I would kind of walk through that, especially since Google is probably about 3% of my portfolio, and I need to see if I need to make it more. So let's kind of go through my thoughts on Google. So strap your seatbelt on. We're about to go for a ride. So first of all, if you're not aware of what's going on with Google, or I should call it Alphabet, Department of Justice proposes a Chrome divestiture along with other consequential remedies. This is Morningstar's assessment on this. On November the 20th, the Department of Justice submitted its proposal for remedies in Alphabet's Google search antitrust case. Among other remedies, the proposal calls for a divestiture of Chrome, reduced self-preferencing, the removal of search agreements, and data sharing with rivals. So there's this buffet of things that they are recommending for Google or for Alphabet, because they're saying that they have this this monopoly, and we'll just kind of keep going. I'll give you my thoughts here at the end. So Morningstar says, hey, why does it matter? Out of the 3 antitrust cases faced by Alphabet, the Google search antitrust case is by far the most important. In that context, we believe that the DOJ's proposals, if implemented as they are, would have a material impact on Alphabet's cash engine, Google search. From our vantage point, we think that the DOJ's proposal contains a set of remedies that are unlikely to be implemented. And I'm hearing that from many different sources, that the DOJ's proposal contains a set of remedies that are unlikely to be implemented. We believe that even if the ruling by Justice Mehta, hopefully I'm saying that right, includes some of these remedies, they are unlikely to be held up in an appeals court. So what they're saying is, even if there is some of this that gets implemented, it is unlikely to withstand an appeal. From a timeline perspective, we expect the ruling on the antitrust case to come in mid-2025, with Alphabet appealing the decision soon after. The appeals court could take another year or so to release a final judgment, which we think will be materially different than the DOJ proposal. So I wanted to share that perspective with you. And then the last thing I'll share from Morningstar is the bottom line. Bottom line is, we are maintaining our $220 fair value estimate for Wide Moat Alphabet and continue to view the name as materially undervalued. While we understand investor caution around the headline risk associated with the name, we believe it is attractively priced for long-term investors. With shares down 5%, we believe investors are also overestimating how much of the DOJ proposal will feature in remedies imposed on Alphabet. So, long story short, they're saying that that they think the investors have really overinflated what this DOJ proposal is going to be, and that it looks like 2026 would be the earliest that we would see any solid impact from these proposals. So we have that, and so what do I think about that assessment? I think they're probably right on. I'm also hearing that that from other streams. I think even Joseph Carlson had a stream on the other day where he talked about that, and his source also said it is highly unlikely that the DOJ's proposal would be carried out. But let's just say that it is, right? And let's say that, how can we tell whether or not this is kind of priced in or not? So the first thing I want to share with you is Morningstar's fair value. So as you all know, I let Morningstar do a lot of the heavy lifting around fair value calculations. I can do them. I can do net present values. I can do some of the parts things, but life's too short. I have bees. I have honey business. I have grandkids. So life's too short. So I let them kind of do that. And then I just look at their write-up and see if I agree with it. It happens to be that Google is saying that they are, Morningstar is saying that Google is fair valued at $220 per share. I think on Joseph Carlson's show the other day, he said it was $260 per share. I think that's a little rich. I would prefer the 220, actually. So with that, it says that it's a 25% discount compared to its fair value, its longer term fair value. So what does that mean? Well, let's take a look at some of the info from the 10K. This would be 2023's information. 2024 will be coming out, the next couple of months. But I think for what we're looking at, I think, the 10K from 2023 is just fine. So you see here that their total revenues for 2023 were $307 billion. That's a lot of money. $307 billion with a B, billion dollars. $175 billion of those revenues came from their Google search sector. So their segment, I think they call it. So the Google search segment produced about $175 billion of revenue. If we look at this by geography, it looks like around 48% in 22, 47% in 23 is coming from the U.S. And I think that's an important point that I haven't heard anybody bring up, is that this is a US DOJ. It is the United States Department of Justice. It impacts the US business of Google. So I think we could say that it is roughly half of their business, because, you got 30% of the business in the EMEA, which is Europe, Middle East, and Africa. And then you have the 17% of the business in Asia Pacific. And then you have 6 in, the Americas, South Central America. So, I think that's an important point, that this would only impact the U.S. business of Google. But, we looked at the revenues, we looked at the geography. The real point of this is that the operating income for Google is mainly, as you can see, mainly in Google services, which is where all of this resides. So what I did is I said, hey, you know what? You got $96 billion in operating profit, operating income. How much of that is at risk? And so what I did is I did a little analysis. That analysis says, hey, what if the U.S. business drops by 20%? Let's say that the U.S. DOJ has their way, which is highly unlikely, but let's say that they do, and the U.S. business drops by 20%. If I took, excuse me, guys, if I took their $95 billion and took 20% of that business away, assuming that 20% would have grown at 10% per year, and an 8% discount rate over the years, that would be roughly a $17 per share impact. If it drops 50%, and remember, the U.S. business is half of the total. So if the U.S. business drops by 50%, that would drop the total business by 25%. So if it dropped by 50%, that would be an impact of $42 a share, roughly $524 billion. So what does that mean? Well, if we look at the valuation of Google, Morningstar has it at $220 per share. It is currently priced at $167. And so therefore it's undervalued by about $52 per share. You got 12.5 billion shares of Google. And so therefore it is undervalued, according to Morningstar, by $655 billion. So even in what I believe would be the absolute worst case scenario, where half of the U.S. business drops, that would be 25% of the most profitable segment of Google. That would be $524 billion. It still would not cover how investors are punishing it at this point. So is there a lot of risk there? Absolutely. So what are the takeaways? Takeaways are the DOJ lawsuit introduces risk for Alphabet. There is no denying that. There is definitely risk involved here. The outcome is unknown. And so therefore there's a lot of risk, right? And anytime there's uncertainty, investors will always, I say always, 95% of the time, they will think the worst and they will price the worst into the stock. We saw that earlier this year with ADM, and we see it now, I believe, in Google. What is risk mitigation? First of all, it impacts the U.S. business since it's a U.S. lawsuit. Secondly, DOJ's proposals are unlikely to be implemented. So that is another risk mitigation here. Then the long-term impact may be less than what investors have already priced in to the stock. So here's a big question. What am I going to do? Am I going to increase my investment in Google? It's most likely. I'm looking to take Google to maybe 5% of the portfolio. It's currently sitting around 3%. So when I do that, I'm not really sure, but I am looking seriously at increasing my stake in Google. So then what should you do, right? Should you invest in Google? And I would say it depends. It depends on your risk tolerance. It depends on your goals. And the reason I put this in there is that I never want to tell you what you should do in your portfolio, because you are the chief investment officer of your portfolio. All I can share with you is what I see and what I'm doing. Hopefully it's nugget of information for you to kind of put in your toolbox. And but it is your decision how you handle Google. Shannon mentioned earlier he doesn't hold Google. It's too risky for him. I get that, and I respect that. Not all of us need to have Google in our portfolio. Alphabet, sorry. But hopefully this has been helpful to you. So with that, I will come back and come back to the comments here and see where we are at. Let's see. Forgot where I left off. All right, Fast Eddie. Hopefully your wife's not watching tonight, but Fast Eddie said he wished his wife would get that sickness where you can't really talk. So I don't know, my friend. Hopefully I don't get you in trouble. So Jim said he got some free Google for opening his SoFi growth account. That's actually going to be a good deal, I think, for you. So Michael says, hey, has he ever failed? And Jim says, no, but I don't want him to get too overconfident. I don't think that'll happen, my friend. I'm struggling tonight just to make sure that I can, keep this going. This is about the longest I have talked since I had this. So, all right, El Dynamico, what is the IBIDA, maybe that's EBITDA, EBIT, yeah, EBIDA, EBITDA. And what does it have to do with the stock? I'll come back to that, El Dynamico. Let me write that down because that's a little bit more of a technical question. But EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA, I think is what they call it. So it would be EBITDA. And what does that have to do with the stock? That's a great question. So let me come back to that here in just a few minutes. If Google spins off Chrome, I see a Standard Oil situation where the sum of the parts is greater than the whole. Yeah, it could be. I think there is some value though to Chrome being a source for Google. So for instance, I have a web browser that came with my machine. It's Microsoft Edge, and I use that. But what does it use for search engine? It uses Bing. And I'm too lazy to go in and change it to Google. So, if Chrome does spin off, then I'm not sure that it does make a greater whole or some of the parts than the whole. I could be wrong though, but certainly respect your thoughts on this though. Oscar is on, man. It's nice that you're here. It's good to have you on the show. Bjorn is here. Greetings from Thailand. Good to see you, my friend. Suzuki Man has Google and Amazon in his rollover IRA. That is good. So Russ wants me to look on Simply Safe dividends. Their dividend payout ratio is super low. So let's do that. I'm going to do this. I figured out a way to make this a little bit more user-friendly when I change all these screens. Okay. So we're going to look up Google. And that there's really two tickers here. One is Goog and one is Google. And they're two different classes of stocks, and one has voting rights and one does not. I tend to go with the one with voting rights, but I really kind of look at both to see which one's trading lower. So let's take a look. So it's first of all, it's got a dividend safety rating of safe 80, and its dividend yield is really low. So I don't know that dividend is really the main driver here, but I think dividends give us a good picture into the company and a picture on where they think the long-term growth is going. So once they build a history of growing their dividends, then you can get a sense for where they believe the long-term trajectory of growth is. That's why I love dividend growth investing, because it gives a picture into the mind of the executive team, the board of directors, on where they believe the long-term business is going. Let's see. Yeah, their payout ratio is 5%. It's very small. And they just started paying a dividend. So it's not really a long-term look here, but 5%, 9%, it's really, really low. So I think the dividend is pretty safe, but it is a very small yield. So I agree with you, Rust. I think it is super low and the dividend is safe, but it's not a huge reason that I invest in the stock. But that's a great point. Let's see. Yeah, Michael says he also has his doubts about what the incoming administration will do with the DOJ's claims. Yeah, I mean, that's another aspect of this, is that I don't think the new administration is going to see things the same way as the outgoing administration does. And I think the outgoing administration is just trying to make some points before they get out of there. And I think some of this will take a lot different trajectory once the new administration gets in. I really believe that. Yeah, Google does have a higher yield than Apple, but it's not. Neither one of them are lighting the world on fire, right? So, all right. Fast Eddie here says, question: the only thing you haven't figured in is what all the other people in the other countries are going to do with their Google stock. Yeah, I mean, who knows? I think we'll just have to see. So what would cause them to get rid of their stock? And that would be if they believe the company is valued on the market higher than the value it will bring long term. So I don't think that is currently the issue, and so I don't expect there's going to be a lot of sell off, from other countries either regarding this. So. But that's just my opinion. We'll just have to see. So what if they all get scared and start to unload their Google stock? Yeah, I think that could be the case. And if it is, I think I'll be there waiting to try and pick some of those shares up. So that's really what we want, right? I mean, as investors, we are looking for times when the market gets the valuation wrong. That's what we're looking for. And we won't ever really know that until the future, because we're looking into the future. We're predicting the future. The market also is looking in the future, predicting the future. But sometimes the market gets it wrong. And when they do, we want to jump in and take advantage of that, even if it takes a little while for that to come to pass. So that's kind of the way I look at it. That's my investing philosophy. So, I tend to, I have really three types of investments I look for. One is an income investment. That would be a company that I believe is solid, that is growing its dividend, that is growing its business, but paying a higher yield. And so if that's the case, then that's an income investment for me. The second one is a value investment, and that's where I believe the market has undervalued a stock, and so those I jump in on. And the others are growth stocks. They're dividend growth stocks. It's companies that are growing faster. They may have a very low yield. Google is an example of that, where they have a low yield but a high growth trajectory. So those are the three types of investments that I look for. So anyway, you could be right, Fast Eddie. I don't really know, but I can tell you that if they all get scared and it drives Google stock further down, I think I'm buying some more. So let's see what Jim says. Charlie Munger had this to say. Munger believed that companies would use EBITDA to hide the fact that they were in debt or not making much cash. He said EBITDA, I won't repeat that. So that sounds like Charlie Munger, but we'll get to that here in a second. GE. I'll add that to the list here. We'll look at that here in a few minutes. I haven't looked at GE in quite a while. I went through the original GE when Jack Welch was there, and then afterwards, and then it all kind of fell apart. So it might be good for me to take a look at that with a refreshed vigor. Yeah, new attorney general in town. That's right. And based on what I'm hearing, this is her. I think her name's Pam Bondi. She looks to be pretty tough. So we'll just have to see. Mr. Income says Google has spent 2 decades weaving dominant segments to complement each other. I think they will do what they say and fight it hard until the end. Yeah, I think that's right. New Prez despises big tech for media favoritism. So I think January will be interesting. Yeah, I don't know that he despises big tech. I think he does despise favoritism, but I even heard him say that he was not out to get rid of TikTok, for instance, that he wanted to save TikTok. So we'll just have to see kind of where things go. Campaign trail is a trail that is littered with promises and innuendos. So we'll just have to see what really happens. So with that, let's kind of switch and go into. I promised it is 8:30 my time, so I promised my friend Steve that we would go through the news. So let's do that. Let's go through the news. So you guys can see that. Let's go to the latest news here. We'll flip down. I think 7 days ago is November the 18th. So let's pick it up at November the 19th. So there's nothing. So November 15th. So Merck is raising its dividend by 5.2%, marking the 13th consecutive annual increase. So Merck, so if I were there's been a lot of conversation about Pfizer and, that Pfizer is cheap. I think Pfizer is cheap, but I think it's also a cheap company. So it may or may not be undervalued. It might be cheap, but it might not be undervalued. I think Merck is a better company. And so if I were to invest in another pharmaceutical company, I do have J&J. I don't think I have any more. But if I were to invest in another one, I would look at Merck as compared to Pfizer. So, but anyway, Merck has raised its dividend by 5.2%. I see my buddy Russ has joined us. Good to see you, my friend. Steve said that you forgot to cover the news, so we're hitting that as we speak here. So November the 19th, we had UVV, which is a tobacco company. It's I guess they grow tobacco, and they're trying to kind of go into other agricultural things. They have rising debt, declining smoking. Cloud Universal's dividend is outlook is going from 60 to 50. They're downgrading it. So if you own UVV, that's something to keep in mind. Here's an interesting one. McCormick Seasonings. I really like McCormick Seasonings, but I think everybody understands them and wants to be a part of them, and it is historically overvalued. But I think I'm going to start adding it to my my stock tracker. So I've written it down here, and so they are currently. It says here that they've hiked their dividend by 7%, achieving the 39th consecutive annual increase. So that's a pretty nice dividend increase. And, so you remember earlier I mentioned that the reason I'm a dividend, one of the main reasons I'm a dividend investor is it gives insight into what the board of directors is thinking about the long term. So if McCormick is growing its dividend by 7.1%, that means that the board of directors believes, based on their long-term projections, that the company can sustain a 7.1% increase in its dividend in the long run. Now, do they perfectly know the future? They don't, right? But they have a lot better insight into their future than I have. So sometimes they get it wrong. Let's do a real quick look here. And here's one indication that I look for. This is McCormick, and I look at their earnings payout ratio. If the earnings payout ratio is staying pretty flat, which it has risen here recently, but if it's staying pretty flat, let's take the years 2014 to 21. You can see that every year they've grown their dividend. In that period of time, their earnings payout ratio has stayed roughly flat. That means their business is growing by the same amount that they're growing their dividend. So if you're looking to value a business and they're growing their dividend and their earnings are growing at that same rate, then that's a pretty good indication that they believe that their business can sustain growths in its dividend. And so that's an important point, and I don't want you to miss that. Some people don't look at it that way, but it is important to recognize that we don't want companies who are just raising their dividend. We want companies whose business supports raising the dividend. And so that's what we're after. McCormick looks like in 22, it went up a bit. So it's staying kind of elevated in that 58 to 60% range. That's about as high as I want it to be. So I'm going to add them to the tracker, but I'm probably not going to invest anytime soon. I need to see them pull back a bit before I do that. So that's MKC. I'm going to go ahead and hit GE. So let's take a look at GE. I have not looked at GE in quite a while. So let's take a look. Let's see what's happening. So their dividend rating is safe at 70. And dividend yield is pretty low at 0.62%. Wow. Look at their dividend growth, 250% this past year. But it only got the yield to 0.62%. So not that great, I guess. So it looks like in June of 24, they've slimmed down their operations and improved their balance sheet. So that's good for them. That's fantastic. Payout ratio is 22%. That's very healthy. Over the last 5 years, they have decreased their dividend by 36%. So it looks like they took it way down back in 2019, down to something that is very, very small, and have grown it 250% this year. Let's see what some of the numbers are. Yeah, they took it down to 8 cents per quarter. Now it is 28 cents per quarter. So, I would need to really look at the business and what they're doing to get too excited about that. Their earnings payout ratio is around 22, 23%. That is very sustainable, very doable. Earnings per share looks like it's started to recover. So that's fantastic for them. Let's see. Sales are beginning to recover. Return on invested capital is beginning to recover. So that's fantastic. So it looks like they are beginning, their net debt to capital is only 27%. That's great. They've got a little bit of an issue with their interest coverage, but that doesn't seem to be, too terrible. So, I would say, they're starting to look better. Let's do, real quick, just because I like to do this. Let's go to Morningstar and look at GE. Let's first of all see if they cover it. Oh, that's GE Aerospace. Yeah, that would be it. Its fair value is 194. It's currently trading at 180. They consider it in a fair value range, but it's probably about $14 undervalued according to Morningstar. So, that's good stuff. Just for grins, let's go to Fast Graphs. Yeah, and Fast Graphs, it looks to be pretty overvalued. Let's go out to the max and see what happens. Yeah, I like to usually go out to 10 or 12 years, but yeah, according to Fast Graphs, it's overvalued. According to Morningstar, it is roughly fairly valued, and so it's something to keep an eye on. It sounds like they're beginning to turn the corner, so maybe that's a good thing. So that's GE. Now let's talk about EBITDA, and I'll just kind of do this off the cuff, on the fly, as they say. Let me find my cursor. There we go. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And so what Michael said earlier, I think it was Michael, or maybe it was Jim, about it was Jim about Charlie Munger, and that it was they were trying to hide the fact that they had a lot of debt. So they wanted to look at earnings before interest, taxes, depreciation, amortization. And the theory behind that is if you were to buy a company, you would need to finance it yourself. So if you had, let's say you're Google or Microsoft, and you got a bunch of cash sitting on the sideline, and you paid cash for this business, what would you expect those earnings to be? Well, it would be the earnings before, and then your tax situation is different. So you take away interest, taxes, depreciation and amortization because you're going to revalue all of the assets anyway. And so that is kind of the theory behind EBITDA. EBITDA is the value of the business to a prospective owner, excluding anything related to valuation of assets and debt and taxes. So that's what it is. Let me look back and see. I forget what the question was now. I'll find it here. What is the EBITDA and what does it have to do with a stock? Some people like to use EBITDA. I don't like to use EBITDA. I think it's important when I'm buying a stock, I'm not buying the business. Let me back up. I am buying the business, but I am not buying enough of the business to put any financing toward their debt. So I want to know, how is the business, how profitable is the business given its current cap structure? That includes interest, it includes depreciation, it includes amortization. So I want to know, I'll look at cash flow if I want to exclude depreciation and amortization, but I want to know what the earnings of the business is. So I don't look at EBITDA. Some people look at debt to EBITDA. Some people will value a business based on it. So they'll say, hey, I'll go 10 times EBITDA for the value of the business. I just don't think that's a good way for us as investors to value a stock price, because it's excluding some very key components, especially the cash flow with interest and taxes. So I don't want to exclude that. So I don't look at that. I look at earnings, the earnings payout ratio. I'll look at earnings. I'll look at cash flow, but I typically do not look at EBITDA. So what does it have to do with a stock? I think it distorts what we as investors should be looking at. So I don't look at it. So, hopefully that's helpful. My friend Antonio. Let's see. So my buddy Russ Knopf is in the house. Did you see Alta Pop? I did not. Good thing I recommended it yesterday. So let's take a look at Alta. I have not. I don't track it. Let's take a look at it. Get back over here. Oh yeah, there we go. So let's take a look at Simply Safe first. It's a beauty. So it does not pay a dividend, first of all, and it operates as a specialty beauty retailer. You can tell I shop there a lot, huh? As beautiful as I am. Let's see, earnings per share is doing the horseshoe thing, where it goes up to 26 and 24 and then down to 23 in the next 12 months. It's buying back a lot of shares. Return on invested capital looks really good though. That's good. And you can see here they even have this in Simply Safe dividends, net debt to EBITDA. I don't ever look at that because it doesn't mean anything to me. I always look at net debt to total capital. So that means that in the cap structure, 39% of their cap structure is debt and the other 61% is equity. Interest coverage looks like they have I'm not sure why they don't have an interest coverage. So I would have to look into that, because they do have debt. They have a 39% debt. So that means they have to have some kind of interest coverage ratio, but obviously not. So now, my buddy, let's take a look at, kind of where it went. Let me go to this other thing here. We'll go to tip ranks here and look at Alta. So, wow, yeah, 7%. Great job, man. So my buddy Russ, I'll get you off the screen there. My buddy Russ must have recommended the stock, and it jumped 7% today. So What's the old saying, Russ? Even a blind mouse finds some cheese. So and the question is, did you invest in it, and did you capture that 7%? If you're still around, let me know, because that's kind of important. So yeah, so they are down in the last 3 months. They're down only 3% now. Must have been 10% yesterday, and so they're down 12% in a 1 year. So yeah, I don't know. I did have to get off of your live stream early last night. We had some visitors come in, so yeah, I did not see it pop, and it's not a stock that I'm typically interested in, mainly because they don't offer a dividend. And I mentioned this early on, as it's not that I want companies that only pay dividends. It's that the dividend gives me insight into the long-term view of the board of directors. So that's why I believe dividend investing makes more sense for me. It's that it gives me a view into the company that non-dividend companies don't share with you because they don't have to. So hopefully that makes sense. Okay, let's get back. Where do I need to go here? Let's go to there. All right. There's this other YouTube channel that live streams on Sunday nights, and they didn't do the news yesterday. Yeah, that's right. That's what they told me, Russ. So I decided I would cover for you. I'm here for you. I always got your back, man. All right. Seeking Alpha gives GE 2 strong buys, 1 hold, valuation grade of D. So that's good. It's good to know. I'm not sure what to do with that. Let's take a look at tip ranks real quick on that. That was GE. GE. Let's see what the analysts are saying for them. Dun, 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 dun. They have 10 ratings, 10 buys. Wow. So the analysts are saying buy it. It's got a 16.59% upside for the top analysts. All analysts, there's one, I guess, this poor lonely analyst. So if you look, it goes top analysts, there's 10 of them. All analysts, there's 11. So there's this lonely one analyst who is not in the top ones. So sorry, dude. But anyway, he's obviously got a higher expectation because the upside is 17%. But if you just look at the top analysts, they look like it's going to be a 16.59% upside. So, you just never know. Looks like it might do okay. And Rust is saying, didn't GE spin off part of their business recently? I haven't followed them. That seems to ring a bell. It looks like they're focused on aerospace now because it's called GE Aerospace. But I'd have to look back and do some research on that. Hey, no worries, Shannon. It's good to have you on the show, man. He's got to drop off. So we are at 8:48. So we got about 12 minutes to go here. So what do you guys want to talk about? I think I've hit everything I needed to today. Let's kind of get at what you guys want. So Russ is wanting to know if Jim's going to buy GE or GEV. So let's see. Russ says, I've heard it put that EBITDA ignores what it costs to replace worn out equipment. Yes, it does. In that it ignores depreciation. So from an accounting perspective, not that I want to bore everybody, but from an accounting perspective, depreciation is intended to simulate the wear and tear on equipment. So if an piece of equipment has a useful life of 10 years, then it is believed that 1/10 of that machine will deteriorate every year, and then you would need to redo that machine, or maybe invest capital in it or replace it at that given point in time. The only downside to that is depreciation never mimics the wear and tear on the machinery. It really depends on how the machinery is used, how it's maintained, and so it is really hard to get depreciation to kind of match up with that. So anyway, so yeah, that is an aspect, Russ. It sure is, but I don't even look at it that way, because it just trying to decide how far to get into this subject, because it bores me. I can't imagine what it does to you guys. But so let's take businesses that have been around for a long time. One of the reasons that we don't look at return on assets for companies that have been around for a long time is that their equipment is most likely written off. It's fully depreciated. So their return on assets is going to be really high. Why? Because their asset levels are low. They depreciated them off. So it's kind of that's why I like to look at not return on assets and not return on equity, but return on invested capital. That to me is a better indicator on how efficient management is at using the capital it's been given to make money for the investor. So I think I'll leave it there, because otherwise I'm going to bore myself. Warren Buffett says of EBITDA, does management think the tooth fairy pays for capital expenditures? Yes, exactly. That is true. I don't own. Oh, so Jim doesn't own either, but he just sees the ratings. Good, El Dynamico. I'm glad that works for you. My eyeliner works great. What do I have on? Oh, yeah, the Ulta eyeliner. That's great, man. Jim says you should see his nails. No, you really shouldn't. I've been, working outside. Oh, somebody wanted to know an update on the honey business. So let me give you a quick update on the honey business. So the honey business started at the 1st of October. And I've actually sold quite a bit of honey. Let me put it this way. I have made more money selling honey in the last 6 weeks than I have made on YouTube in the past 3 years. So I've been on YouTube for about 3 years now. And I have made more money, actually probably 3 times more money in 1 month of selling honey than I have on YouTube. So I don't do YouTube to make money. Obviously, I do it because there's really a couple of reasons I'm on this channel. One is because I want to share with you what I'm learning, and that gives me great satisfaction to that it's not just for me, that I'm sharing it and making it more available. The second thing is that you guys, whether you know it or not, help hold me accountable, because I might do some crazy things if nobody's kind of looking over my shoulder at what I'm doing. So I don't want to make any kind of silly moves in the portfolio, and you guys are a big part of that. So that's why I'm on this platform. So yeah, don't look at my nails. Yeah, WSO Watson, is it Watsco? It has jumped a lot, and I didn't expect that. So yeah, it's good. And I think Suzuki Man owns some Watsco. So great job, man. So Russ says he doesn't invest, but we had a question from a viewer on would I instead buy Ulta, DG, or FMC. Oh, I gotcha. And he chose Ulta of those 3. Yeah, I hear you, man. Yeah, DG's got its issues, and FMC has its issues. That's that agricultural chemical company that I think is losing some of its patent pending or patent protections. So yeah, I think Ulta is probably the one I would have chose too. But if I had the choice, I would say none of the 3. Hey, Gendry's on the broadcast, and it says, look, this beauty company, PAYC. I don't know if I've ever heard of that. PAYC. Paycom, that's not a beauty company. Let's see who they are. Let's go to Simply Safe. PAYC. Paycon. It's a software, human resource software company. So yeah, they've got a safe dividend, and they don't have any dividend growth though, so that would concern me a little bit. And Gendry also says they added LKQ. Let's see, LKQ. I don't know if you can hear my granddaughter in there. She's screaming about something. LKQ, 3% dividend yield. And again, no dividend growth there. So the reason I like dividend growth and I like to compare that to this earnings payout ratio down here is that it gives me an indication. That's earnings per share. Where's the earnings payout ratio? Gives me an indication of where the whether the business can sustain the growth of the dividend, and if they can, it's something that I'm interested in. You can see here that the earnings payout ratio for LKQ is growing, but it is not growing its dividend. And what does that mean? It means that the business is getting worse. So it's probably not something that I would add to my portfolio. I didn't look at it in depth, but it's not something that causes me to want to look at it further. Yeah, Michael, depreciation is a non-cash item. Return on capital employed is a better measure for many businesses. Yeah, I agree. I find return on invested capital is just more readily available. So that's why I picked that. ROIC or ROCE are both really good measures. And Steve says, hey, Russ, FMC is what he would choose. So, all right. Okay. Well, I think we have hit kind of a stopping point here. So where do we go from here? I think Google is going to be something that, hey, let me share this with you real quick. I will get rid of that. I want to share the I'll share with you guys my latest picks. Oops, that's not the right one. All right, so let's take a look at this. All right, so this is my spreadsheet that I built for my portfolio. It is really difficult to use, but I didn't use it really or build it to be shared. But you can see how the portfolio is done at a glance. I can see my investments by category, by sector, by moat. I can see that today the portfolio made $7,300 and went up 0.44%. The futures, S&P futures for tomorrow look like it's down about 0.08%. There's just a lot of information here that I like. It shows me my current portfolio, my historical portfolio, the transactions. But then I also have this sheet in here that tends to value companies for me. It's not that the companies will be exactly what I say in here, but it has a way of comparing companies with each other and where I think the companies, which companies are going to do better than others over the long term. And the two companies that I'll share with you that I think are buys for me, I've got several buys here, but the two that I'm looking at are Elevance Health and Alphabet. You can see that ConocoPhillips is still at the top of the list, but I'm kind of waiting on that because this whole idea of the petroleum in the new administration, I'm just not really sure where that's going to head. So I'm going to hold off on ConocoPhillips, Chevron, any of those types of investments. EOG, I'm holding off on those. I'm kind of keeping what I have, but I'm not going into those realms right now. I'm looking at Elevance Health and I'm looking at Alphabet. Hershey's right behind that, but I'm just not yet ready to jump back into Hershey at this point. And Realty Income is also a buy, I believe. So, yeah. So but it's these two mainly that I'm looking at, Elevance and Alphabet. So don't be surprised if I increase my holdings in both Elevance and Google. you can see that Google is Alphabet, sorry, is 3.01% of my portfolio. Elements is 2.44%. So where are they at? Right now, I'm up 6.67% on Alphabet, and I'm down 2.92% on Elements Health. So I will be looking to add a little bit to both of those in the near future. So hopefully that's helpful. And that gets me right at 9 o'clock. Let's see if there's anything else. All right, LKQ is growing his dividend, but paying a few years only at start. Okay, gotcha. Yeah, I'd have to look into that further. Yeah, drill, baby, drill will not benefit oil and gas. I agree with that, Michael. That's why I'm holding off on my CO, whatever that was, ConocoPhillips. So I think that's exactly right. All right, guys. Well, we did it. We made it through. I think it was much better than 2 weeks ago. So I'm glad you guys were here. Let's go make some money. Let's invest in the market and get some things done. So with that, I'm going to sign off, and I will see you next week.